In July 2026, Grant Thornton Advisors announced its acquisition of professional services firm CBIZ. The all-cash transaction carries an enterprise value of $5 billion, representing a 54% premium over the company's 30-day average share price. Merging these entities creates the fifth-largest professional services provider in the United States, with a global platform generating nearly $7.5 billion in annual revenue. The institutional architect of the deal is New Mountain Capital, a New York-based private equity firm. This consolidation contains a structural contradiction. To complete the deal, CBIZ's Benefits and Insurance segment, a division reporting $401 million in 2024 revenue, will be carved out and set up as its own independent company. This separation of a high-revenue division allows the firms to bypass the regulatory roadblocks that would otherwise prevent a private equity-backed entity from acquiring an accounting firm. Traditionally, public accounting firms operate as partnerships. Equity is held exclusively by practicing professionals, and expansion is funded through internal earnings and partner contributions. Private equity operates on a buy-and-build strategy, using institutional capital to execute rapid roll-ups and back-office integrations that many partner-owned firms cannot fund. In the United States, however, state and federal laws strictly prohibit non-CPAs from owning any portion of an audit practice. The $5 billion Grant Thornton and CBIZ transaction is engineered specifically to navigate these ownership restrictions while maintaining the flow of institutional capital. This structure provides a template for how private equity firms are now systematically integrating into the regulated professional services sector. Over the last decade, CBIZ relied on aggressive acquisitions for 75% of its growth. Financial pressure became visible in their Q2 2026 reports, showing flat revenue and a 55.6% drop in GAAP net income. Integrating Markham's strained operations, leading management to pause significant acquisitions. This stagnation caught the attention of activist investor Reference Equity, which claimed CBIZ's capital structure was constraining its ability to lead industry consolidation. Reference Equity proposed suspending share buybacks, raising $175 million in equity, and reactivating the M&A strategy. Their aim? Reach the scale of the Big Four by 2035. At the same time, Grant Thornton announced a $1 billion commitment to AI and technology, an investment partner-led firms struggle to match. Unable to reactivate its own M&A pipeline or match these technology spends independently, CBIZ's board accepted the $5 billion buyout as a path to fund its long-term technology objectives. Regulators, including the SEC and the AICPA, mandate that only licensed CPAs can own equity in firms performing attest and audit services. This means New Mountain Capital cannot directly own a firm that signs audit reports. To bridge this gap, the industry uses an alternative practice structure, or APS. Under an APS, operations are split into two legally distinct entities. First, the attest entity, 100% CPA-owned, performing audits. Second, the advisory and tax entity, a corporate business providing consulting, which can be owned by private equity. A contract called an administrative services agreement connects them. Through this, the corporate entity leases staff, technology, and office space to the CPA firm in exchange for administrative fees. Grant Thornton and CBIZ both currently use this structure to separate accounting from consulting. When New Mountain Capital invests, its $5.2 billion flows exclusively into the corporate entity, leaving the audit firm independent. The APS allows a professional practice to function as a private equity-backed corporation while technically complying with CPA ownership laws. Even with the ownership problem solved, the firms must still navigate audit independence rules. An accounting firm generally cannot sell complex financial products, such as insurance or retirement plans, to the same companies it is auditing. This creates a conflict for CBIZ's Benefits and Insurance segment, which provides payroll, health benefits, and retirement advisory to thousands of businesses. This segment is substantial, generating $401 million in revenue in 2024. Merging Grant Thornton and CBIZ would massively increase the number of clients shared by the audit practice and the insurance practice. This conflict risks SEC independence violations, which would void those audits. The solution? Completely separate the benefits and insurance unit. It becomes a standalone entity, backed by New Mountain Capital, but legally severed from the accounting platform. This move allows the insurance business to sell products and acquire other brokers without creating independence issues for the audit firm. The spin-off is a structural requirement used to protect the regulatory standing of the core $5 billion accounting business. The final result of this deal is an integrated accounting platform, optimized for consulting and tax, running alongside an independent private equity-backed insurance firm. This dual-track strategy allows the investors to maximize returns across two different sectors while avoiding regulatory conflicts. With a $1 billion technology budget, the new firm can deploy AI-enabled capabilities across a multinational footprint spanning 20 countries. The combined entity now possesses the capital to invest in technology and talent at a scale that smaller, partner-funded firms cannot reach. This consolidation model represents a shift for mid-market firms that have traditionally relied on slower, organic growth. By utilizing private equity capital to bridge the technology gap, the new organization is positioned to pursue Reference Equity's goal of challenging the scale of the Big Four by 2035. The $5 billion privatization of CBIZ replaces the traditional partnership model with a corporate structure designed for institutional scale and investment.